going to be a scan for the week of the 27th, I think. Am I mistaken? Yeah, the 27th. 3-day weekend. Not too much to unpack as far as what happened last week. It was a lot of, dare I say, what I expected, right? The sequence in the scenario that I kind of expected to occur, right? We had the window opening up for short-sided trades. We had the clear exhaustion following a not historic move, but a notable footprint and large signal and campaign that marked this up 20+% off the lows. That is now coming to an end. And I mean, it's pretty simple as to why I was short side focused and as to how I plan to execute going forward. You know, I shorted this week for a good win, but I left a little bit on the table and I didn't play it to the extent that I wanted to, but there's always going to be other opportunities. And I did swing some short over the weekend, which is kind of risky, but I don't want to say too risky just because of the potential opportunity for buyers up the 200-day to get trapped. But nonetheless, you know, we had the window of vulnerability short side. We had May OPEX on the 16th, large call heavy chain expiring. We had Vixpiration, which is kind of the remainder of hedges that are propping this up. And you had a rally that at some point, right, you know, down here it was phenomenal long, a phenomenal long-sided trade. Shares wise and options wise, you had the subsequent digestion on a lack of effort from sellers during a short week, and then we had, you know, the continuation. And you know, at some point it just becomes unappealing long, mainly as we begin to see the micro distribution, especially when the, you know, April 3rd gap fill is being filled on spot or QQQ, and we'll begin to see this kind of fizzle out. But then we have the gap down on the 30th that's bid up off that GDP print. Right? We have the continuation of this in reports. And, you know, this was kind of the last opportunity for me personally to want to focus long, was into that window of vulnerability starting on May 5th when we had the heavy flows kind of propping us up higher, right? Because you have so many calls, right? You have so many dealers that are negative exposure to Delta, and you have them buying the underlying, buying futures to hedge themselves, right? So this is naturally going to be propped up. And that's why you see this float higher. That's why you see this, you know, develop this look where it's kind of a lockout, right? You can't get any long exposure that really is optimal, right? Like taking this long exposure, especially with the Fed meeting and that end of day pop, and then the stalled distribution above the May 2nd highs on the 8th is not appealing, right? Taking this is kind of appealing, but a little speculative into the reports, in my opinion. Obviously, this is a place where a higher low can be established, but I don't really find myself being super fond of taking that. And, you know, we get the gap up to begin the week of the 12th, and there was no real opportunities except for building out shorts, being patient, waiting for that window. And that's exactly what I did, right? And that's exactly what we got. So, you know, just taking a look at the weekly candles, this is absolutely disgusting. When the volume comes in at the highs like this, especially after such an exhaustive gap, and especially after, you know, a higher time frame rotation out of equities, in my opinion, right? We don't have a real good sequence building up here on a higher time frame weekly perspective, right? I think you've had money rotating out of equities since potentially last summer, and then even more in Q4, especially off that election, and then obviously we had the markdown, the reversion trade, right? The reversion to the mean, and now we have, you know, the highest volume since the week of the 7th that comes in at the top of this rally, right? And it comes on a gap down, a failure of the gap, and a red closure on an unappealing print, right? You know, 2.5% red week is putting in 440 million volume. The prior week, 5.5% green, putting in 360, right? And that was already a good pop in comparison to the rest of this. So a lot of red flags, right? QQQ, you see the exact same thing, fading the highs, fading the new week opening gap that we had on Monday for a couple reasons, and just an unappealing sequence alongside, in my opinion, right? And so, you know, watching how this developed, especially with that seller on the 12th, bid, see stronger close. There's not too much volume. See the continuation, the kind of 15-minute pullback, hourly pullback, and then the continuation higher that's just floating, right? Even in the OPEX, right? This was a sequence where the highs are being sold even off open, but we're being propped up by things under the hood that are very relevant. And it's no surprise to me that we begin to see the nice legs, right? We see the nice leg Thursday after hours. They revert that into close. See the rally that's stalling at 590. This is where I begin to position myself short. And then we see the kind of float on OPEX. I did attempt to short this end of day. And of course, we get the move after hours, right? But this is one of those things, you're not really going to see the market top on a Monday or on a Friday, especially with an after hours sell like that, right? Maybe if it happened off OPEX, it would have been a little bit different, or off of the hedges and winding. But it happened after hours. This is an auction. There's still orders that need to be filled. There's liquidity built up there, and we end up reverting that and seeing kind of a buyer off open. This was the largest retail amount of stocks bought from retail traders, I think. Let me pull up the picture. Because this is a hilarious picture, right? Because, dude, it's hilarious because we have the most stocks bought during the first 3 hours of a trading session in history occur on Monday, on the 19th, off the Moody's downgrade. Who's selling that? One, who's selling that to them? Two, they're buying these 20% off the lows, right? 23% off the lows. And, it's natural. We see the bid. We see the closure kind of on low volume, right? A gap down like this on low volume is very interesting because you have a nice buyer off open on terms of the volume on the hourly perspective, but stalls off on highs. And when there's not that much volume on a daily perspective on a gap down like that, it's a very big red flag. There's not a large footprint in a large buyer. It's those weaker, uninformed hands that are bidding this up here, right? But we're still waiting on that window, right? We start to see the breakdown, or the gap down on Tuesday, stalling within this gap, right? You're not really seeing the lows kind of bid. We started to see phantom prints as well be put in at that 588 spot. You're not really seeing phantom or nice legs higher. You're seeing the lows bid, the highs sold. You see a nice breakdown. There's a bidder here at 590. It gets the strong close, right? Gap down on Wednesday. Pull back into that gap. Here's a news print with the higher volume, highest volume of the session at 9. We see the pullback. We see the pop. And then like a 5-minute distributive look in terms of the high stalling into a bond auction. That gives you this massive leg down, right? And it's no surprise that this happens, right? This is not an appealing sequence. This is a gap down that pulls back, takes out the highs from the previous week and the closure. There's a lot of kind of, spying that occurs up there. Yeah, there's a lot of buying that occurs up there, offering that counterparty fill for the larger hands. And like I said, it's that Friday on that not a notable footprint kind of candle on the after hours sell, and then the gap down the next day, right? And we kind of fail on a daily perspective, get anywhere above the previous weekly close, right? And we see the nice leg, nice volume, a nice bid here of 590, but they really can't close it on an appealing look, right? This is not like an inside bar pinning it above 590. This is a gap down and a weak bid that can't really get an appealing close, right? Failing the gap down as well, understanding that this is still a red day, right? Then we see the subsequent breakdown on Wednesday, right? Those flows expire. We see a weak pop. We see very low volume. This is a big red flag to me when you see the low volume kind of reversion into the gap, into your golden pocket as well. It's your first initial lower high right at that golden pocket, and we see the breakdown the next day. So that's the highest volume daily print we've had since April 11th, right? That's a $10 day, fading the highs, fading this distributive look, and giving you your first potential lower high developing here, right? The next day we get a small gap down. A small gap down if I'm not mistaken. Bid off of 581.47, the May 12th open, the top of this new week opening gap. And then we see the subsequent failure, right? When you analyze the strength of this buyer, right? Because there's going to be a buyer down here, right? You're seeing attempts to mark this up. You're seeing buyers attempt to mark this up, and it's just a lower high that's established. And if you pull your fibs again, what is this? This is your second lower high, right? And it's noted by the sweep of 581.40. They reclaim it, and there's no lows that are bid underneath this, right? There's no kind of hands that are changed in terms of rating stops under these lows, trapping those late shorts and stopping out those longs. It's the exact opposite, right? You're kind of fading the highs, right? Where you see the counterparty liquidity built up at each one of these intraday highs, and the attempts to mark this up be stalled as well, right? When you have sequences like this, it's the exact opposite, right? It's those. Trying to think here. It's those shorts that stop out, buy it back, and then there's that opportunity for someone to be that counterparty to the party that's attempting to sell it at the highs, and we see the weak rallies. We see the failure for any lower lows to be swept in terms of building out a campaign to mark this up. It's the exact opposite, right? It's a weak bid, high sold off, weak bid. We see the failure at the highs again. There's another notable failure at this liquid range, the previous high of day, breakdown, attempt at a higher low that's met with a really weak pop, more volume coming in here, right? There's some longs that are stopped out that causes them, there's some shorts that are stopped out that causes them to buy it back, offering an opportunity for them to offload their inventory, and the same kind of concept as well with the late longs that get trapped up here. The longs that get trapped up here in terms of buying the breakout potentially. And it's all just to the 0.5 where we have that larger seller show his hand. We see the breakdown in the close, and then the subsequent gap down the falling session. Right? This is a hourly distribution, right? I'll pull up the picture as well. This is an hourly distribution that's showing its hand, and you have a structure that's developing, right? You have the preliminary supply on Monday, May 12th. Have the potential for that to be a buy climax. I'm not going to label this directly at what it is. It's more or less just building out of the cause, and then kind of establishing that campaign in terms of offloading the inventory, wiping some of the parties dry, and then when those flows leave and all those things that are propping up this market, it's free to move in whichever direction, right? Especially with volatility the way that it was pinned. And, that causes a lot of, like I said, these dip buyers to get smoked, right? A lot of these dip buyers that are attempting to bid this up, that did so on Monday, that may have worked, are now also underwater, right? When you see this lower high developed off of the Monday low, there's a lot of these dip buyers that are underwater here, and that causes them to sell off their position, and that kind of can exacerbate the move, right? And then we see the lower high, see the breakdown off news again, the subsequent digestion, and now what are we developing here, right? A bearish progression, reclaim of 581.40, also that 618, and a weak close in terms of a 1.5% breakdown that last hour of this session. Or 3-point breakdown, $1.5 breakdown that last hour of this session with extended trading. So it just, it's just how these things move, right? When you see the massive footprint candle in the weak bid and the lower high, the draw is going to be lower to an area where there's a larger amount of demand. And that's kind of what you get here as well. Not on Bitcoin. It's kind of what you get here as well, where, there's a large buyer here, but you kind of can see the intraday failure for, like I said, any lows to get bid, any late shorts to get trapped, and cause them to buy. Or fucking Christ, I'm out of it. Any late shorts to get trapped under these lows, right? And any early longs to get washed out, right? There's more or less the exact opposite. Any early shorts getting stopped out at these highs, and any longs that are attempting to position themselves having to I don't know what the fuck I'm saying. It's just a lower high, right? We have the lower high that's established here, the high sold off, right? That's kind of signaling the weak bid breakdown, and the same exact thing. You would have wanted to see on Friday, if this was in a mark back up, in my opinion, the lows bid, like I said, those longs stopped out, causing them to sell. offering the opportunity for a larger party to buy that counterparty, and offering an opportunity when those, you know, shorts show their hand, they stop out as well. Wait, I feel like I'm getting it all wrong. I feel like I'm just ranting here, but the counterparty liquidity built up when each new high is sold. There's a lot of buying that's done at the taking out of each new high that causes the longs to stop out, um, or the shorts to stop out, right? And that's kind of the exact opposite of what you want if you were long side focused here. Wait. Yeah, yeah. You know, you're stopping out the early shorts, washing out the early shorts at each new high, and the draw is just to an area where there's a lot of intent and relevance behind. And that's the exact opposite of what you want to see on an accumulative sequence, where it would be the exact opposite, right? If you're seeing each new low bid, right, taking out these lows stops out the longs here, causing them to sell, right? And that can spark a rally that can change the hands. And it's also the shorts that take it on the break of structure that have to wait. I feel like I'm fucking this up aggressively. Um, but that's not what you see, right? You see the highs sold, right? If someone's short here, they have to buy it back. That offers an opportunity for them to get sold too. And the same kind of thing, right? Just that counterparty liquidity and the highs being sold, signaling the weak bid, and the draws just to an area where there's a larger amount of supply. And, you know, this is a speculative short, right? I covered my short too early. I talked about that in the recap. I just went on a rant about counterparty liquidity and how hands can change. That can build out a campaign, you know, wipe out. You know, this is wiping out a lot of demand as well, especially like I said, when you see the higher lows attempted and the stalls, you're not seeing anything we built out to develop a trade higher, in my opinion. A little bit speculative of a swing here, but you have a really disgusting weekly closure. I executed up here and covered it way too early, but we see the gap down in the potential third lower high on what could be your sign of weakness here underneath this entire structure. And I took some Julys off 581.47. I think I'm up 6% in the close. All I'm looking at is 564, right? I think that can happen within the week. I think that's a little speculative, but I think that this is a very bearish sequence. I'm very bearish on equities right now. And this is a very bearish sequence where a lot of dip buyers are going to be smoked. A lot of dip buyers are going to be underwater, causing them to sell. And when they begin to flip short, I think is when we have the opportunity to get long, right? Now, if we reclaim 581.47, I'll cover my position, and I'll probably look to short in this general range, right? The Tuesday closure, the imbalanced print from Wednesday, where there's some relevance behind. You know, obviously we're pinning it above that 576 spot and the May 12th low, so that's a little speculative. But I think this is a very weak buyer, very low volume traded on this leg where there's a bid, but he's very weak. I think the draw is going to be to the 564 range. So I did swing that over the weekend. I would not be surprised. It was a little tinfoil hat, but we manifest this over here, right? To see a breakdown over the weekend, right? This is a very a candle that is reminiscent of the March 7th closure, right? Where we see this kind of markdown, lower high, markdown again. They start bidding the election gap, see the breakdown under it, and then you know March 7th, right? We see a gap down in a buyer. This is a relatively bearish print, but or bullish print in terms of wickage and a nice closure near the highs, but it's still failing that 576 spot, right? It's failing the progression gap. There's a seller that's pinning it, and there's the opportunity for a lot of these buyers here to get smoked, right? Hands to change, and then they begin to bid this to get a potential leg higher. So that's kind of the same scenario here where we have a gap up, a relatively appealing close long-wise in terms of the daily print, I guess you could say, but a failure to progression gap, and I think my risk to reward is there where I think this can take us down to 564, and I can short the pops on June. So all I'm looking for in this position is 564. I'm not going to overcomplicate it. I'm just going to go gap to gap. If we lose this, I'll short it higher with even more confidence and more size. But nonetheless, you know, ignore my rant on counterparty liquidity. Um, it's very unappealing alongside when you see the bids and you want to analyze and break down the follow through, right? And when the highs are sold and there's no lows bid, right? There's no cause built out and no supply wiped, right? There's still sellers in this range, and it's the same thing here, right? Where there's a bid and they're kind of wiping out the demand, selling out the highs, trapping out, washing out those early shorts, um, and exhausting and wiping out the demand as well, um, and trapping out those longs that have to take them to the highs. So, yeah, you know, you get short, you stop out, yeah, just offering that counterparty liquidity, which is a great reason as to why Monday, which I began to add in at lower high territory, was not the top, or Friday was not the top, and Monday ended up being that. QQQ is a very similar sequence, right? You have your lower high, and you have the same thing here on Friday as well with the massive breakdown. This, however, is your first attempt in this May 12th gap. This is holding up relatively strong, but a very unappealing weekly candle as well. Fading the gap down, fading the highs, and in my opinion, a potential sequence that could also give you that push down a little bit lower to the 492 range, right, in terms of where the draw is going to be. And if it doesn't, yeah, then you can short it again up here within this imbalanced range that's left over from Wednesday this week. It has a lot of unfilled orders and liquidity within that range. Like I said, with the fact that it's an auction, right, there's orders that need to be filled. And if we begin to see them pin this gap, the draw is going to be up there a little bit, in my opinion. So, little speculative swing, but I think the potential is there on SPY. I wouldn't necessarily try to short Qs down to 488 yet, but definitely a big red flag, especially fading the Wednesday low, right? So, here you had a 2.6% day. I really would not be surprised to see that happen to begin the week. Obviously, I'm saying that because I'm short, but it's just the sequence overall, the potential for these dip buyers to get smoked once again, and then that could spark maybe a pop-up off the nvda report that's faded up here. So similar kind of sequence, right? Similar kind of distributive look. Wednesday was the UTAT here, just relatively range bound. Like I said, highs being sold, no new lows established that are really getting bid aggressively, except for that Monday print that was all retail, and then the UTAT here that developed the lower high and potential secondary last point of supply here developed on Friday. Financials as well, right? Very gross weekly candle closure, and it's happening in that range where there was a previous distribution, there was a gap fill, and the previous highs, right? You had the distributive look, the relative underperformance on May 12th, and the exhaustive low volume. Look at the volume on May 19th and May 20th of this week, right? There's no effort from a buyer up here. It's being propped up by things that are under the hood, and once those are gone, right, we develop that massive breakdown, and it looked hideous beforehand as well on Wednesday. And we see the massive breakdown, the lower high, and then a potential for this to be a lower high as well, which is a little speculative, but just a very unappealing chart, right? And not an aggressive buyer whatsoever. And if this pushes down to 49, I could definitely see this giving you back up to that $50 range and offering a re-short. Genuinely just depends on where we look at this week. But the same kind of concept as SPY, right? I'm not going to short this yet. If we get a push up higher, this will probably be my vehicle within this range, down to 49 bucks. There's a large quarterly OPEX in May or in June, and those flows return the 9th. So I'm really in short the lower high in mode until the week of the 9th, and then I'll probably take a step back. So if we bleed then, right, if we bleed into then, if we just continue to see this bleed down to like 48 bucks, you could get a really nice short opportunity post-June OPEX as well. So something I'm going to keep my eye out for as well is the financial sector that looks absolutely hideous. And the consumer staple sector, that not the most appealing weekly candle closure. The weekly sequence is pretty appealing, though, in my opinion, as far as the relative underperformance post-April 7th move. The bidding of the January lows, the relative strength this had from January to March, and then we see the breakdown, lower high, massive print on the 4th, and then the reversion trade that, like I said, underperforms relatively notably, but inside this range internally, as you can see on a weekly perspective, they're kind of bidding the lows of this, and you see a nice footprint the week of the 12th that, this underperformed, but saw a nice wick on Monday, saw the exhaustion from sellers, a nice pop, the stall at the upper confines of this range, the kind of weekly highs and the lower volume pullback into the golden pocket range, beating the Monday, May 12th low, and kind of stronger close those two sessions, Thursday and Friday. Not anything I'm going to long, but a big red flag overall when XLP looks like this and SPY looks like this. In terms of, and XLF looks like that, right? XLF being very distributive and very unappealing is a very big red flag market-wide, in my opinion. This is something that oftentimes front runs these distributive looks. You have the same thing that happened in March, right, where this was kind of outperforming in terms of this rally. It was all just mitigating into the range where there was a previous buyer that was wiped, and there was an opportunity. Not an opportunity. There's a previous buyer that was wiped here in this distributive look, and you see them kind of painted under that previous support at 50.75, 50.75, yeah. Where the progression was very weak from that bid, and you see the breakdown, lower high, and then the April 3rd and 4th sequence. So big red flags overall, right? This is not anything I'm longing. The options chain is kind of hideous, but when you're seeing those kind of internal lows bid, like I said, those shorts stopped out, or no, those early longs stopped out, and those shorts kind of getting exhausted and trapped under here, that sparks a nice rally, which, like I said, it's the opposite, right? You have the undercutting of these lows causing a lot of selling to happen from the shorts that attempt to short this underneath these lows, underneath the structure, and from the longs that get stopped out under here. That can spark a nice leg. So a very notable red flag when you have XLP looking kind of appealing alongside on a daily perspective. I'm not really the biggest fan of XLE personally. This held up kind of nice on Thursday, but I just don't really have much interest in there. XLY is a very similar chart to SPY, right? This is kind of the same thing, gap down, failure of the gap in the weekly high, ugly close on the highest volume we've had since the week of the 7th on an extensive rally that began to exhaust itself in the gaps. Saw one last hurrah, the steam's running out, and the late longs are getting trapped, and the nice footprint on Wednesday, right? So it's just a lot of things that aligned, in my opinion, that caused this move. And it's just a lot of things that aligned that aligns with the sentiment, aligns with the late buyers being trapped and more than likely being forced to liquidate and get stopped out when they're underwater, and then when they're starting to flip bearish is when they start to get trapped again. It's the same thing that happens over and over again. XLK is very similar. This closed right under the weekly candle open from May 12th. This is a very gross candle closure on XLK, and the same kind of concept as well. I think this is the fact that they pinned this under the May 12th open is very appealing to me, right? You could see a quick mark down to 217 this week, in my opinion. And these look fucking phenomenal long in terms of the potential springs, right? Where, like I said, you have these lows taken out, you have the exhaustion from sellers, and you have those hands changing, right? In terms of a lot of selling being done by trapped or by shorts that are attempting to short it under here, and by longs that are being stopped out. You see this nice footprint candle on the 13th, and then the low volume consolidation on this on SQQQ under these lows. It's a very big notable sequence for me, in my opinion, the way that these leveraged ETFs work and look, right? Bonds, I don't really have much to say about bonds besides the fact that yields looked good, performed decently this week. And I don't know, when yields trade higher, oftentimes when yields trade higher, bonds trade lower. I'm not a master in these. I don't want to kind of say such a thing, but bonds could be a potential long here, in terms of risk off opportunities, right? I'm not 100% sure. I do note that there's oftentimes sequences where this correlates directly with equities. Sometimes, like in January to March, this outperformed. But in December of 2023 to April of 2024, this aligned with the rising yields and the falling equities. So I'm not really going to concern myself with this too much, but bonds could potentially trade higher soon. I have no clue. Just something that I'm noting in terms of yields trading higher, and potentially signaling that risk off, right? When you have XLP looking good, which is a risk off asset, and you potentially have bonds being a long opportunity with when the bond market potentially does outperform. I think that could be a red flag for equities in terms of, okay, yields would trade lower, but now we're just seeing risk off in bonds. Maybe they try to save the bond market, which, the 30 years at 5%. Maybe they try to save this and they end up fucking the equity market. I would not be surprised to see them try to save the bonds, and then a lot of people that are bearish bonds get trapped as well. I have no clue though. This is a very ugly closure. I will say that this is not an appealing chart on futures as well. Volatility, right? Like I said, those expirations. I circled the past of expirations. The most important ones being the December kind of buy climax and exhaustion into the Fed meeting, that January all-time high stall, and then the deep seek gap, which was potentially that first domino to fall, and the February one at the all-time high failure again in that UTAP, right? And then now we have the May one, right? That sparked off the low of May of expiration, a 45% move to the highs of Friday, right? That's not unwarranted. That's not random, right? Volatility was free to move, and we see the extensive pop on VIX, right? These no longer bound by these hedges, no longer bound by these panning of volatility and suppression, especially on such a call heavy expiration, right? And now we have the potential for VIX to really get going, which is a big red flag. There's something that you could also kind of correlate with the fact that the potential selling of vol was used as a hedge at VIX at 60, and now that we're down 70%, a lot of people could have to buy back vol. That could really exacerbate this and spark it higher in terms of recovering their positions, right? And it's kind of a short covering rally on vol. I don't know though. That's speculation. And then Bitcoin. This is a great long down here, right? In February, March, and April, when they have the climaxes and the subsequent consolidation built out. But now we're pushing all-time highs with a very gross 4% candle on some volume. This is not, I would not want long exposure. Bitcoin, if anything, gold looks like it could potentially outperform here. And that's a big red flag, like I said. You want to focus on money always rotates. Money's always moving. And when you see risk-off names, potentially bonds, that's not something I'm going to speculate on, but potentially bonds down here, gold, consumer staples, all risk-off assets that oftentimes outperform the broader market in times of weakness, right? Investors and smart parties place their money in these, and as they rotate them out of the other assets, right? They could be front-running something. I mean, I think they are. But you see this aggressive rally on Bitcoin, the all-time high sweep, and I saw Michael Saylor tweet out, if you're not buying Bitcoin at all-time highs, you're missing out. No, that's a fucking terrible idea. I think that this right here is a great example of rotation into risk-off assets. Gold looks relatively decent as well, following the parabolic short. They kind of consolidated this, bid the lows, like I said. There's a buyer at these new lows, seeing nice legs. I didn't necessarily give you another short that I liked, but a big red flag overall when you have different assets and different asset classes and different just risk off names looking good alongside, and risk on names like Bitcoin and risk on sectors like technology looking very terrible on not only a perspective of here, but on a higher time frame perspective as well, right? Only other thing besides SPY that I'm really looking at to execute on this week, right? The only thing that I'm looking at to trade this week is SPY short to 564. That may not happen this week. If that doesn't happen this week, that's great. I get to short it again. The only other thing that I'm really short on, unless XLF pushes back up to 50 within this window into June 9th, besides SPY, maybe QQQ, probably not QQQ, is nvda, right? We have a higher time frame weekly distribution that is occurring following, October 2022 lows to March 8th, we're up 740%. To 2025 highs, we're up over 1,000. That's insane, right? And what happens when such a sequence happens, when you're up 700% in March 8th? You see the first footprint of a seller, in my opinion, and then we see the continuation higher. And what happens again? There's a larger distribution of inventory happening from a larger party, um, being even. I'll pull it up on here. I don't like Trend Spider, but this was a very interesting chart that I saw. Right, all the insider and larger parties are selling their inventory at the highs, and you're seeing it. Yes, we get a reversion trade, about 45, 50%, 58%. But there's not enough of a campaign built out off these lows, in my opinion, to spark an aggressive rally to new highs with the campaign and cause that was established here, right? Remember, cause and effect. The cause is going to develop a subsequent effect. And when you see all these highs in this distribution on a higher time frame perspective of things with massive liquidations at the highs, lower highs established here, um, and then in this range, this little kind of sequence is not going to spark an aggressive rally that's meaningful, in my opinion. Yes, we get the August 5th lows taken out. Yes, we get the May gap filled and pulled back into. We see a nice leg initially. The digestion, underperformance of this name, yes. And then we see that kind of rally on this following what was notable underperformance on nvda, right? But not necessarily a short here, just a consolidation. It finds a higher low. You see the breakout and then a 16% week where this is just not appealing. I mean, like if you had shares from down here, great. Get out. I don't think this is appealing. But we had the seller from 115 kind of wiped. The pop on Wednesday, the gap up within this gap that was faded. But that May 12th in log, 5.5% occurs, and there's not an aggressive enough seller in this range, right? There's a large unbalanced earnings candle that was never touched from February 27th. There's that window of strength with the flows in the May OPEX, and that's exactly what you get. This aggressive rally, and then a lot of people get long, and then they're going to get trapped up here, and that's exactly what you get, right? You see the stagnant price action on NVIDIA, the highs sold, no new lows established, right? Just the higher highs sold, right? That causes a lot of buying from stops being short and from long, or from shorts being stopped and from longs that attempt to take it. Getting trapped, and then when they sell, then it gets exacerbated, and we develop our UTAD and lower high on Wednesday and the Thursday. The gap down and open up about 130, and you see a close that, if you're calling this a bull flag, it's a terrible idea. But I'm not going to short this yet. We have the report. We'll have to see how we open up this week, right? Like I said, if you get a quick markdown to 125, that could spark that collection of inventory and changing of hands, right? So if we get a new week opening gap, if we get a quick markdown here, that could spark an inventory collection, changing of hands. Like I said, if everybody starts to get bearish on a new week opening gap, kind of stopping out a lot of those dip buyers, and then you see a markup off the report that's faded even more aggressively, I would not be surprised to see 115 this week. Kind of reminiscent already of this range, right, where you see the February OPEX and the deep seek gap fill, the exhaustion, the breakdowns, and then the kind of weak rally, right, where you see a quick breakdown, a weak rally into a gap up where it's faded on that report. So definitely potential for that to occur. I'm going to watch it, not really on a massive position. I'm going to watch it more or less off of the report where we open up at. If we see something like that, whether it be like a earnings miss and a massive breakdown of 115, I would not be surprised. Or a gap up that's fadeable on like a double beat, because those reports, like I said, offer a ton of counterparty fills and a ton of counterparty liquidity, and it's just a very volatile event that offers an opportunity for the informed party to sell it to the uninformed party trying to buy the report. It's a simple thing, right? The news is a catalyst. It's not random how these things work off of news. It's not random, that tariff news on Friday morning dropped us another from 582 to 576, right? It's not random. The campaign is established, and when that occurs, That's an excuse, right? It was bound to happen anyways, and that's not random. That happens at that time, and then that sell occurs. But we'll see. Meta, a very very shitty weekly print as well, right? This is a potential higher time frame distribution that's occurring since the February 20% beat, a 20% gap up, where like I said, we see the highs sold, right? We see things that generate a lot of buying and offering an opportunity for the informed and larger, smarter party to offload their inventory. And then you see the potential UTAD in January and February, the aggressive markdown. And another name like nvda that was kind of an underperformer, right, where we actually had the sweep of the April 7th lows on very low volume, and then just a rally that was very unappealing, right? Very similar to nvda, they began to show their hands as far as the seller goes above the April 9th high. But we don't really get that aggressive move yet, and I think that's just because of the time frame and because of the window of strength that we're in. The gap up and failure after reports, very, very notable. And then you kind of had some continued exhaustion, failure on Thursday. And then the massive gap up that's giving you that kind of last hurrah. Like I said, that window of vulnerability leaves us, right? On Monday, we have the Monday gap down, and there's just really no strength behind this bid that sees follow through, right? The lower high on Tuesday, on Wednesday, off the discounted range, you see the 10-point candle. And then the buyers kind of wiped off 630, right? They've been trying to bid it up Friday, Monday, Wednesday, Thursday. That buyers kind of wiped. That supply or that demand is absorbed, and the path of least resistance is established. And especially on a print like this, where we gap down, fail 631, and see that kind of weak candle closure. There's a little bit of volume behind it, but that's not appealing. If they pin this under this range where they previously absorbed it, very similar to SPY, I think this can see sub 600 by the week, which, like I said, is a very speculative thing that I could to guess. But I think that's going to be the next spot where there's a buyer on Meta, a larger buyer, and some money built up, right? Look at that. Look at the volume profile, right? You see the exhaustive look. You see the stall in these gaps in the lower high territory. And then you see the path of least resistance established, the demand absorbed, and the pinning under this previous weekly open, right? Where there was some intent behind, there was a relevance behind that, and it's absorbed and pinned under. So Meta is a short, in my opinion. Weekly closures are horrific, and this is a potential last point supply in a weekly distribution that begin to give you these looks back here, right? Where this potentially could be your buy climax, your reaction. Your UTAD, this could potentially be a last point supply, and then you'd have a sign of weakness under here. This could potentially be like your UT range. I don't want to label it directly, but just a notable red flag there. Tesla, I don't know. I don't like this chart much either. I think this was a great long, about 60% lower. I think this was a potentially good long. If you're taking long exposure that week of the Fed meeting, which I just wasn't going to do this week, the week of the 5th, right? I just wasn't going to take long exposure. It was just an environment where I think the play was carry out your longs, ride out your longs on commons, and wait for an aggressive window to short. And, if you want to take some long exposure Tesla here, I don't mind it. But then you get this aggressive parabolic rally where I think there's a lot of selling into strength, and then a potential hourly distributive look where you have this Monday print being pretty ugly, this Wednesday print being pretty ugly, the high sold, attempts to mark it up off these lows, sold off again on Tuesday this week, right, where you have a weak buyer here, and the potential for this to pull back is there. A lot of volume coming in on the Tuesday print. Not anything I'm going to short, not anything I'm going to long. That 360 spot's pretty important. The November 11th high, but this is your golden pocket short from the December highs to the April lows. So there's something there. I'm not going to trade this though. Google finally gives you a nice pop. There were some great reversion trades that I think they're done. I think a lot of them have been done for a little bit. SPY and QQQ mainly. The only other ones I liked were, like I said, an nvda look off 85 to 90. Tesla maybe, probably not, and Google and Microsoft. Google up this March gap fill from the beginning of the week of the 18th. It's phenomenal, right? You had a previous buyer here, you're taking out these lows. There's a lot of liquidity and money built up in this range, and there's a lot of hands that change that sparks this rally. But now you're seeing this ugly daily candle closure on Thursday. You kind of see an underperformance on this, right? Not unappealing candle closure on the report, potential lower high. This massive news print on notable volume that was kind of absorbed, in my opinion, when you analyze the volume, the spread, the reaction. But then this is kind of getting that last push, in my opinion, where they more than likely bid the news and they're not selling it off at the gap fills, the progression gaps, and what is your golden pocket short. This could have a little bit more left in it, but like the spot to long this was 140, right? If anything, I'd long at 140, cover at 160, and hold a little bit to 170, 175, and then be done. I don't know if this pushes all the way to the February peg, especially with this massive footprint, but the spot to long these were lower. You're getting a kind of unappealing weekly print, and it's just notable. Apple, right? You get a 7.5% week. This is a shitty chart, very similar to nvda, a higher time frame distribution that is not yet completed, developing its secondary last point of supply, where the May 14th gap happened above those highs. There's a lot of selling that was done on this day, on this gap up, off news, and occurring in this April 3rd gap. The 10% gap was very extensive. You see the markdown of the report, kind of exhausted seller, and the draw into that gap in the week of the 12th give you that little shitty look, right, where it's that gap fill, that seller showing his hand, but it's being propped up, and then once those flows leave, we just see this waterfall down. A lot of volume on the Friday print, but not anything I'm touching long. I'm also not going to short this. I think there's other names that are more appealing. Microsoft with a very gross candle as well. Like I said, the spot to long this was the 2021 highs at 350. Right, and we see the digestion, we see the rally into the report where you're now seeing that selling into strength. You're now seeing the selling at the highs and the late buyers being trapped. It's notable. Yeah, we pinned a little bit above the earnings gap, but that's not the main concern of mine. You continue to see this exhaustion and this notable weak candle fading the highs on Friday or on Thursday and the Friday. Fading the December highs as well. So not an appealing chart for me. Amazon's a very similar one, right? Great long, 20-something% lower, 30-something% lower. I don't really like this long that much. It was kind of building out some sell climaxes in February and March. But I think the Google and Microsoft and NVIDIA ones had more pivotal areas, right? This was a nice gap from February 2024. Obviously get the reversion trade, the digestion, the higher highs, higher lows, higher highs, higher lows, right? Kind of failing this April 9th print, but the effort from that seller is not really the most aggressive. And then the exhaustive May 12th gap up, where it's kind of that last hurrah, in my opinion. This isn't an hourly short, in my opinion, either, but I wouldn't touch this either way, right? The time to long this was lower, the time to long everything was lower, and now it's done, in my opinion. So, other than that, RTX distribution is pretty notable as well. This is simply put a pretty aggressive move on RTX, especially from 2023 lows. This was 100-something%. And you kind of begin to see the preliminary signs of a seller following the July report, where it's the 8% move. You see the notable footprint on October 2024, the markdown after somewhat, right, in terms of the seller showing his hand, not really being aggressive enough. There's still buyers within that range. Kind of bid this up into the rally that we see in January. And then here's your kind of potential buy climax here in January, where you have another report that's faded. This is a 3% new high in 100 days, like 60 trading sessions. Higher low attempted, another high sold off, right? So now you're seeing higher lows attempted, highs being weaker than before, right? This is 34 days, 22.2%. Not highs being weaker, but you're seeing higher lows attempted and buyers kind of being wiped and sellers showing their hand at the highs, right? And then you start to see another you see another nice leg off of this, a 3.5 or 3.8% candle. Higher low attempted, another stalling and pressing at the highs. This time you get a really nice leg off of it. You see the reversion into the gap. You see the breakdown off the report. No new lows bid. No notable kind of accumulative sequence here. And a rally sparked off that sold on Wednesday on the news. I think that was the Israel news. 2% in 56 days, and the highs are sold on a gap up with a lot of volume behind it. Not anything, I'm only really focused on this, right? This is a very similar chart to nvda back here, where you have this UTAD here, the high stalling, the attempts at higher lows. All a distribution is selling it higher and wiping out the demand, right? And once there's no buyers, once all those buyers are wiped, the path of least resistance is established. I wouldn't short this yet, right? You want that character change to signal that the draw is lower, right? So like if you see this buyer off 130 be very weak, float into this range, there's a lot of imbalance behind this gap that was faded on Wednesday, right? And if you see that opportunity, you could push this to like 126. I compare this a lot to nvda. The same kind of sequence, right? Attempts to mark this up, stalled at the highs, a UTAD here, massive footprint on a gap up, the kind of continuation, and then you see that buyer show his hand. That's really, really weak, a really weak leg, just mitigating this drawdown. We see expiration as well this week, and then we see the breakdown again for the 27th. So something I'm kind of keeping my eye on, more or less just preliminary, a 4, potential 5. I don't know if I want to call, I guess you can call this 4 higher high distribution with the preliminary signs in October of 2024, but kind of a beautiful look in terms of highs being sold, no new lows established, very aggressive moves that occur here that spark weak rallies, very aggressive breakdowns, and kind of the lack of any aggressiveness from a buyer and a notable seller at the highs. And now you get a potential UTAD where it's an aggressive gap up that sparks a lot of buying that's sold too, especially on that news. And then once they get to selling, it gets very exacerbated. And when that character flips, I have an objective risk to reward and an asymmetric risk to reward in my favor to trade this lower, to where if that buyer off the 130 spot is weak, I can trade this down to 126. So we'll see how that develops. A mature distribution for sure. A campaign that's being built out for potentially over half a year. Schwab, another bank that looks weak, right? But I don't really have an edge here. I think this is all daily distribution, and this is our UTAD, right? Like I said, when you see a distribution like this, and you see, legs get really aggressive from the seller's perspective, gap fills being rallied off of that are very weak legs, and there's more sellers at the highs. This is your preliminary sign. This is your buy climax, your reaction, your UT, your pressing at the highs, your sign of weakness in this range. And now we see the UTAD where it's a buyer off of $70, but a very, very gross leg, where it's more or less just a lot of selling into strength, right? So that's gross, but I don't have an edge here, right? If they give us a last point of supply, if they give us like 81, and then, like I said, if banks give us 48 and then 50, this could be a good short here, but nothing I'm going to touch yet, right? TSM, I haven't really seen an opportunity to get aggressive short on this. Pretty similar sequence overall in terms of a lot of names, higher time frame distributions, markdowns that occurred, rallies off this April sequence, and weak legs propped up by short covering and flows. And those flows are leaving. We're now seeing the stalls. We're seeing the preliminary signs on this name developing in early May, but no real edge for me here yet. Palantir is a distribution that I think is going to take a little bit. I think you see a buy climax off of this February report with a distribution beginning following the election and the November earnings report. 20% move above new highs. I think you begin to see that distribution. Like I said, you see the buy climax, the potential reaction, no bidding of the lows internally here, and then a rally that's sparked off of this April 7th sequence that's once again kind of sold off into. You see the volume spike at the highs, and then the reaction be very weak. Not really pin it, not really break and base the highs, more or less that influx of volume be sold to in a nice leg after, signaling that there's a lot of supply up in that range. But nothing that I really have an edge on yet, just a leader that is potentially in a higher time frame distribution, giving you what could potentially be your UT. Very similar concept with Hood. Right, these are also names that made historic. Like I said, leaders. names have made historic moves. From 2023 up to this, it's 1,700%. Hood's very, very similar. From 2023 November up here, it's 750%. No edge here yet, though. I think preliminary supply, buy climax off that report. Like I said with these reports, they generate a lot of counterparty hands, generate a lot of that counterparty liquidity. Generate a lot of that counterparty liquidity, and that's why you see a nice leg off of it. A lot of late buyers trapped off of what they think is a great opportunity to buy Hood off their earnings report. And a nice leg where, like I said, you see buyers, you see, in this instance, Lowe's bid, but the leg could be very weak, right? It's just analyzing, it's just supply and demand, right? And analyzing the strength of these parties, analyzing the strength on these parties and the behavior, and the legs that they get. And so you have a seller up here. This is a gap fill. It hasn't been filled yet. This is the IPO. Oh my goodness. The August 5th, 2021 gap fill. It hasn't been filled yet. The highs weren't taken out, so I have no real edge here. But as far as like the 66 highs, I don't know. But just the same kind of concept, right? The preliminary signs of distribution, a campaign built out here that sparks a nice leg, but nothing that's appealing to me, and something that you just take into consideration. Right? Like I said, an accumulation is bidding of the lows, wiping and wiping up a supply, trapping the early longs, and a distribution is selling off the highs, wiping out the demand, and trapping the early shorts. And in this case, you have a nice leg built out off of these lows bid in quarter one and into the early parts of quarter two, but nothing, in my opinion, that is going to outweigh the campaign built out here. Right, the accumulation within this range is not strong enough, and there's a larger seller and a large amount of supply up there, in my opinion. UNH, I don't know, historic volume, but I have no edge here yet on this name. Something that I'm paying attention to. But nothing that I really have much of an edge on. Nothing that I really have much of an edge on. A lot of names look fucking terrible, is what I'm seeing. Right, a lot of names look disgusting. I don't think I would have any long exposure equities unless it's in a leveraged ETF. GME squeezing as well is kind of a red flag. In quantum, like, in quantum, giving you a rally, these high short names is just unappealing for me. When you have these meme stocks and shit rallying, that's a good sign that the rally's over. When a lot of people start buying those, it's a good sign that the rally's over. Home Depot with a very gross daily print on the report on Tuesday. Lowe's as well looks gross, very gross. Like I said, you have buyers off of April 7th. How does the leg look? And these look very gross on these names. So does Lulu. The weekly chart for Lulu looks pretty bad. I never like confused today. None of these names, to me, look very appealing alongside. Maybe MO, if they pin this at 59, right? Like a 2 to 3 lower low accumulation, wipe some of the sellers out of this range. I think the draw would be up to the 60s, but I'd rather short some names. Doesn't look terrible, but I would need like higher lows on all of those. Walmart doesn't look terrible. The gap down off the report, nice leg. The lack of aggressiveness from the seller off this February report that already showed his hand once, saw the breakdown, and twice, and then they bid that off the report. So the draw here could be to the $100 range on Walmart in terms of this seller being absorbed. I don't really care to trade that. Coke, trading the earnings candle open. Doesn't look terrible. No real hourly structure, right? If they pull this back a little bit, maybe start seeing a nice footprint from a seller or buyer that's a little bit more appealing. A couple more lows bid. That could be a nice accumulation hourly wise built out to 72. Something is brewing in consumer staples, in my opinion. Nice 3-day inside bar pattern on Dollar General, right? This is exactly what I'm talking about in accumulation. You have a massive footprint on a 32% breakdown off the report. Nice notable buyer here. Pretty weak leg, right? Not a lot of aggressiveness, not a notable footprint. We draw down, right? We establish a new low. What does this give us, right? Well, it gives us a lot of longs stopped out, a lot of shorts selling. This gives us a nice leg, right? That offers an opportunity for a party to buy under these lows, collect inventory, and that leg is sold, right? And so the draw is lower. They bid the lows again. This is a more aggressive breakdown. This has a little bit more notable volume behind it on the 21st, and this sparks a really nice leg, right? And this is the same concept, right? There's a lot of volume on this January 8th candle, kind of capitulation day, a lot of selling that potentially occurred under those lows that offers a change of hands, and this sparks a really nice rally. So you're wiping out the sellers within this range as well, the sellers that show their hand that got no progress. You're collecting inventory and you're bidding it lower until the path of least resistance is established into the peg. Pretty simple concept. And it's the exact opposite on a distribution. You reverse it, right? You're trapping out the shorts, the early shorts, and the longs that all have to buy it, or the shorts that have to buy it and cover, and the longs that attempt to long it up here that buy it and don't have an opportunity to sell it. So I don't know why I'm stuck on this. I think I just explained it very terribly. Let's go to the financials. JPM with a very gross chart on a weekly perspective as well, right? Just unappealing, fading those March highs, that exhaustive look. This and Goldman Sachs and Morgan Stanley had a very notable footprint on Monday, right, which was a very big red flag, a very notable seller on Monday. I mean, this has looked like shit for a while. It's just waiting, and then we get that fucking massive footprint, and then the breakdown lower. He said the all-time high failure, the potential weekly UTAD here, right? It takes him fucking 80 days to establish a $2 new high, and the volume all comes in at the highs of that range. The breakdown's very aggressive. I don't like that chart. Same thing with MasterCard at the 580, 590 range. This has a little bit just more notable of a distribution. A nice leg here. The consolidation following the January report, stalling at the highs, trapping a lot of buyers up here, right? And you see the breakdown, lower high, massive sign of weakness, and then the rally that's propped up by flows and short covering, drawing to an area where there's a larger amount of supply. And he said, and the hands changed, and now you see a nice leg off of that. Wells Fargo, another gross weekly chart. Goldman Sachs, this one had the leg on Monday. Just unappealing looks across the board, in my opinion, on banks on the weekly perspective. Nothing I'm really going to short quite yet. There's an opportunity on 51.22 to 51.74, 74, yeah. In this general range, like I said, with the low volume, the notable exhaustion here. I mean, look at how low the volume on these days are. There's no effort from these buyers. It's just waiting for an opportunity, and that's exactly what you get. And this breaks down to like 3%, 3.7%. Very, very notable. A very big red flag market wide. So I'm 100% short focus banks. I just need a lower high first. And if, like I said, if I get stopped out in the short, I take a little loss and I get to short things higher. And if not, I get to short them down to 564 and wait for an opportunity to reshort. It's a win-win for me. No growth names really look appealing to me. I don't like a lot of these. outperformed XYZ. I don't like this. I don't like this. I don't really like Square or Shopify either. I don't know. Some of these don't look terrible. Some of these ARKK holdings don't look terrible. But not anything that I'm touching. I don't really like healthcare names either too much. Don't like much. There could be some risk. There will be risk off longs that are offered. Like I said, you have bonds potentially. With just the sequence overall in terms of Japan yields hitting highs, 30-year hitting 5%, a 10-year looking I think like 4.4 or something. I don't know. But the fear on bonds could potentially be a place to look alongside, in my opinion. In terms of peak fear on bonds, everybody's worried about the yields, and then something swoops in some safe bonds, and we get the pop on bonds. And that's a risk-off asset that could potentially outperform. None of these look too appealing either. Just going to scan some charts. This is a distribution. This is a 3 higher high weekly distribution. I don't know why everybody's so bullish Uber, especially going from 2022 19 to 87.75. Yeah, I don't like RTX looks gross. This is a short focus, a 4 higher high distribution. Preliminary signs showing in October, right? It's just like I said, it's higher lows, giving you weak highs, and aggressive legs off sellers, showing the lack of demand. NMM is in the distribution as well, following a 100+% rally. I don't like that chart. Don't like a lot of semiconductors either. A lot of these pulled back. Qualcomm, that 150 range, that previous floor of accumulation, right, where there's a lot of liquidated positions on the April route or April breakdown, right? A lot of liquidated positions that occurred. And this pulls back into that previous floor of accumulation where we now see a larger influx of volume and a nice seller. Just pinning it under this range where there was previously a larger buyer and they made a lot of progression. AVGO does not. I don't like a lot of these, but I'm not executing short side on many of them. It's a lot of just I'm not looking long on any names. CRM reports this week. Caught some news end of day on Friday. This looks very gross as well. That's a large holding in the Qs. I think SPY. But I don't like CrowdStrike either. I don't like a lot of names. Yeah, I'm not a big fan volume. Pretty simple. It's no nice beat on the report. This is a good long off the November peg, but it's also not the most mature accumulation off the lows and a speculative name. Not anything I'd milk from 120 to 200, but something. So yeah, I mean that's my watch list this week. My main focus is SPY, XLF, and NVIDIA, right? If we just want to pull these up here, XLF, NVIDIA, and RTX. These are my focus is short side, right? And like I said, the only way I did want to compare this to DraftKings as well. The DraftKings kind of distributive look happened in Q1 of 2024, and this was more or less just, like I said, gap down after the report that was bid, and attempts at a higher low that give you this parabolic rally on a ton of volume and a nice amount of gap ups here. and a massive footprint on the 27th, right? That leaves behind a lot of imbalance, and then that breakaway gap from the previous session. And so you want to see that draw occur, and you want to see that seller show his hand within this print. There's a lot of imbalance in money and liquidity in this range, and it's an auction, right? There's orders that are unfilled. There's going to be draws to area where there's a large amount of supply. So you can't really pull your fibs too aggressively here. But we see a really nice leg from high of day here to a 5% intraday move. You can try to play the breakup structure. I don't know. A little weird here. And then the 4% day the following Friday, and then the breakdown Monday takes a little bit. I don't know how I would have played this besides the like open here, and then maybe cover it, cover some, stop out, re-short it that week into the gap below. Yeah, and then wait for a lower high off this report, 53 or 45.62. That would be a good idea. But another just similar notable footprint that digests the imbalance, similar to nvda and similar to what I think can happen on RTX. So that's an opportunity. It's basically, if we can get the move, it's a short week, so I don't expect too much. If we can get the move, off of 580-147, all I'm shorting is SPY down to here. I'm shorting lower highs on a month out or bi-weeklies intraday, especially if you get like 570, see a lower high. If this is not our lower high, if we reclaim 580-147 on a daily perspective, I just get to short it higher. And what does that mean? I get to short XLF a little bit higher, down to 49. I'm shorting the pops till June 9th. I get to focus on RTX. And then the NVIDIA report is a big one as well. If you get a quick markdown, this can signify a change of hands and a collection of inventory that can spark a gap up off the report that can be sold and just trap a lot of longs here, trap a lot of shorts that get shorted too late, and then trap a lot of longs again and mark this down. So that's my focus this week. I kind of went on an accidental tangent trying to discuss what accumulations and distributions are. I don't know what happened, but this is not appealing alongside to me. And if we fail this progression gap, that's going to be my risk to trade it to 564. I'm going to keep an eye on anything that happens over the weekend. How we open up on Monday and Tuesday is crucial. But short week, I'm not going to expect too much besides the NVIDIA report. If we don't get much, I'll probably take short exposure into the NVIDIA report. If we see like a low pop into it, a low volume pop into it, we have jobless claims. And, we do have some data this week. We have GDP Thursday, PCE Friday. So I think things can get going this week. Depending on where we open up, we could potentially, like I said, get this gap fill, get a lower high, get a little bit of continuation lower. I mean, this could be a very mature campaign that marks us down to 550 before we see 6,000, or 5,500 before we see 6,000. And then we see like a 400-point rally in the June OPEX propped up by those flows, and then the breakdown to the 5,300s. This could also just give us 590 and 564, and then we go from there. And I know there's a lot of things that can happen, but I wouldn't be surprised per se to see this. To see this weekly print give us 550 potentially. So I wouldn't be surprised. There's a couple ways that this can happen. It can happen like that. It can happen like that. It can happen like that. I have no clue just yet. Definitely just waiting on how this develops, but SPY short to 564 is still a main focus. I'm shorting lower highs till June 9th. And NVIDIA report's pretty big this week, depending on how we act, but we'll have to see, right? I don't see any opportunity to buy calls. I'm short everything till June 9th, but I'm also going to understand, the risk to reward in my favor in the time frame and how this can set up. So I don't know. I feel like I can expect a good move this week. I feel like a lot of late buyers can get smoked. They can cause a lot of selling. And then when they flip short, we can get like a lower high. Something I think happens this week. I would not be surprised to see 564. I mean, that's just a 2.5% move. So I would not be surprised to see 564 this week on a short week. Right? Similar to this short week, it's just kind of a trend. I have no clue, obviously. speculation is what I'm doing here, what I do. But I'm short focused, right? If I don't get to short it here, I get to short it higher. But I'm short everything till 564 and then probably reevaluating. I'm also short everything till June 9th and then probably waiting for a lower high. So we'll see. A lot of red flags though. Bonds potentially signaling risk off, yields trading higher. That could also set something up as well in terms of late bond shorts getting trapped. I don't know. Consumer staples looking very good. Volatility being unpinned and seeing a nice pop off the Wednesday lows, about 44%. Mega cap tech and financials, the two largest holdings of the S&P 500 indexes, of the S&P 500 index, looking abysmal, right? You have a risk off opportunity. I'm not long any equities at all right now. I don't think that's a good play. I think that was a good play, 20 to 30% lower, and you can cover a good chunk here. Re-roll and reposition yourself in NVIDIA here. I don't actually mind bidding more, like bidding NVIDIA, cutting it, adding back into your position with your risk at this low, and then trading this up to 130. And then, because there's not a lot of aggressiveness behind the seller here, and then we enter that window of vulnerability alongside. So there's a great opportunity long that happened 20+% lower. And now we have the, like I said, you had the exhaustive looks, you had the footprints, you had the signs. Now we had a larger sign, we have a larger footprint, we have a large sell, and we have a window of opportunity that I'm going to look to capitalize on. So good luck, have fun. Do not, please, just like, I don't think it's a great idea to long anything. I think it's a phenomenal idea to short, but short smart. I think something happens this week with PCE, GDP, and NVIDIA reports. Depends on how we open up, but pretty much it.